Chief Economic Global Strategist at ADM Investor Services International, Sarah Akbar, Chairperson and CEO of OilServe Kuwait and Executive Director at Petrofac, and Kieran Gallagher, Managing Director at Vitol Bahrain. Thank you so much, everybody, for joining us this morning. Sarah, good morning. Good to see you again. I'll start with you, and let's talk a bit about OPEC before we get on to bigger issues. Your reaction to the cut announcement, was it timely, in your opinion? And we see a headline there, number one on our news bulletin, saying we actually see their production falling hard in March. Is that the first piece of evidence we've seen since November? Oh, we can't hear you, Sarah. You're on mute.
Good morning, and happy to be back on this podcast. Well, it was a kind of surprise cut, but I think, with the continuous analysis that OPEC does, understanding the market and the various variables, it looks like it was really timely, because I think the target price they have is around the 80, and there was this drifting from that kind of pricing. So I think this voluntary cut came in place. But having said that, I think some of the countries would have gone down anyway. So yes, we always, in the past, when they talked about 2 million, the reality, it wasn't 2 million. It was a part of that, maybe 60% of that was actual cut. The rest was just by the default, countries could not match their quotas, whatever. I think it's a similar kind of situation that we have now. Russia's production is coming down. And so I don't know if they will actually interfere in trying to reduce it. It is going down anyway. So I think it was timely, and it's a very thorough analysis of the market and trying to, stabilize. I think their kind of direction is stabilizing the market. They don't like to see these big swings and the price, and this is the main driver. This swing in the price is not in their interest or the market interest or anybody's interest. So to bring stability to the market is the driver. And the only way they can bring stability is by this interference. So,
okay. Well, thank you, Sarah. Thanks for that. Kieran, let me go to you and ask you if you agree that OPEC did bring stability. We obviously saw a big swing in the price very quickly. But then we've kind of seen price, did they achieve does the market think that they've achieved the objective that they wanted to? And tell us if you think this is a way of trying to keep things stable.
Yes, good morning. And I think it is their attempts to keep things stable. Obviously, the prices were on a slide, but as per last night, we're WTI back to 10, 11-week highs. So they've had a very real impact. I think, commentators such as yourselves, maybe in 6 months ago, were questioning the relevance of OPEC Plus. I think what they did in this announcement over a weekend were largely most countries in that group celebrating Ramadan, but coming together and without any prior leaks or rumors, and coming out with such an announcement, obviously had a $5 a barrel impact on the market, on the Monday morning, and it has largely stabilized around there in the week since that. So I think that it's had the desired effect. Obviously, last night's announcements from the IMF and the tone around those announcements could result in a little bit of nervousness around the market. But I think largely OPEC Plus got the result that they wanted from that immediate announcement.
Okay, thanks, Kieran. Mark, on that point that Kieran mentioned, IMF, we do have the IMF World Bank meetings happening at the moment. They've revised their global growth forecast by a little 0.1%. So taking into account what OPEC is supposedly foreseeing in its action, where are we at today with where we see demand? I mean, the US is not in recession yet. and consumer demand is still very strong, and yet we have all this, these scary headlines. So, where is demand being forecast to be in the second half of this year?
Well, I think what we've got is we're still trying to bed down after COVID. I think one of the problems we've got now is we had massive overproduction in the manufacturing sector during COVID to meet all that goods demand, particularly related to anything which was COVID related. And we also had all those problems with the disruptions. Now we're swinging back to services. So what we've got is a very uncertain situation. What we know is that for a lot of the manufacturing sector, demand is dropping off, despite the fact that actually in a lot of countries, there's a lot of spending going on related to energy transition, related to energy security, not just transition. China is picking up, but it's picking up more slowly. I think what we've got is a situation where the consumer side is holding up a lot better, but the manufacturing side is proving to be a lot weaker than most people had anticipated, which I'm not really that surprised about. We after post-COVID, we went into literally exhaust as much capacity as possible. People basically overproduced to compensate to a certain extent, and now we're seeing this swing. It's a question of balances here. So we're trying to get the pendulum back into some sort of balance, but we've got a very uncertain outlook. The banking sector isn't as secure as we thought it was. Not really surprised. It was always a bit of an illusion. And we're still trying to deal with the impact of inflation and the impact of much, much higher rates. Most importantly, in terms of the higher rates, it's not where, it's the speed at which they've risen. And that is proving to be the big shock to the system above all the banking sector. So to my way of thinking, I think the second half of the year will be better. No question about it. I think China will definitely pick up. As far as Europe and the US goes, probably we start to see, something which is flatlining, getting close to stagnating, but operating at stall speed, largely due to the sharp rise in interest rates.
Okay, and of course we have another announcement in May from the Fed coming up. We have obviously an inflation report as well coming up on Friday. Kieran, just quickly back to you on that point of sort of we're kind of now back in sort of a realistic balance in the markets. Has the market now taken a more realistic viewpoint, do you think, going forward? I mean, between a few months ago and today, we've had a 5 million barrel a day mistake in what we forecast from a supply demand scenario, Are we now being a bit more realistic as we go forward? And what do you take away from the IMF meetings so far this week in terms of demand expectations?
Yeah, I think the main takeaway, my own personal takeaway from the IMF meeting was the nervousness around the tone and that struggle for the medium term outlook. They're trying to cast a degree of realism that medium term the global economy is not in fantastic shape. Again, there's perhaps an over reliance on China to carry this. And we're in for a significant period of higher interest rates to try and calm inflation. So I think how does that relate back to the oil market? Our medium term growth outlooks are certainly on the oil side are certainly put China front and center. Obviously, return in aviation fuel demand is the almost the easy part of that, because I think we really will see a growth in that over the summer months as a bit more long haul flying continues. But more short term than that, we're getting to a period where everyone's focused on China's product imports. Everyone's focused on refinery runs. It does feel like May product exports are certainly going to be no lower than April from China, which is a slight concern. We should see, we would have thought that there'd be a mild tick off in that if that growth story was going to be more immediate. So yeah, I think there is everyone's looking east for the growth story. You know, Europe and obviously particularly UK. It's not
no,
UK.
Forget about the UK. But
yeah.
what about, okay, before I go back to Sarah, Kieran, okay, everyone's looking east, obviously, for the majority of the pull of demand that we'd like to see. But what about, for example, the US economy? We touched on it earlier. Gasoline demand is sort of making its way back, isn't it? But is there any nervousness that we could hit the highs again that we saw last May before we kind of before we saw that retreat?
And you know, we're getting into the season where the gasoline demand numbers should be ticking up in the US, so that's I guess in line with forecasts. You know, I think coming into the year, there was some very bullish expectations on the gasoline market that maybe haven't quite rung through yet, although there is time. I think from hitting the highs of last year, it does look unlikely. Now we're there's more refinery capacity available, particularly in the Middle East, so that there's an ability to meet stronger product demand for certain. It is new, so there undoubtedly will be some blips in production as those refineries come online, etc. But there's a little bit of there's spare crude, but from the US side in particular, obviously the SPR drawdown. We can't ignore that, and on-land stocks are at 5-year lows on the crude side. So there's plenty of risks with regards to price, but you have to look at it and say, well, if OPEC viewed it as a time to cut, that there's potentially a time to return that capacity to the market also.
Absolutely. And Sarah, on that point of OPEC capacity, that's one reason people are saying Saudi did this move, so that it does have that real spare capacity if it sees that it has to bring prices under control for political reasons, let's say, or as they might reverberate elsewhere. But Sarah, give us your update on the Middle East as well as a destination. We've seen this change of flows, obviously, because of the Russia situation. And increasingly, of course, give us an update on where you see the refining output from the Middle East going, the forecast for that, and also how that's being impacted by Russian crude coming in, blended, getting out, etc. Where are we at with that? And do you see that continuing for the remainder of the year?
So yeah, I would like to start with this point of stabilizing, because it's actually not short-term stabilization. It's the longer term that worries us in the industry. Why does it worry us? Because at these prices, everyone is willing to invest in the industry and thinking that we will generate some good returns. But if the prices slip and we go back into the cycle of non-investment, looking into the future, by 25, 26, we will all be in trouble. And this is the point that OPEC thinks about all the time, is how do we make sure that investments flow into this business? As you see in the US, even after the oil prices went as high as 100, still there is not enough investment going into the shale because of this cyclic nature and because of the short term. Let's put it this way. So if we can maintain some kind of stability in the price so that we do get investments back into the upstream that generates the spare capacity that can manage internationally, how do we go? That is, I think, the way OPEC thinks about it, rather than just short term. Now, going back to the refining, as you know, the only new refineries in the world are actually in this part of the world. So we have the Carbonara refinery that is operated, it was opened like a month ago, 140,000 barrels capacity. We have of course, Kipik refinery in Kuwait and Duqm refinery in Oman. So there aren't many people who are building refineries. And for those refineries, in order to get your optimized kind of returns on those refineries, you do need to blend with the cheapest type of crude or with the optimal, so to optimize on the feedstock. And actually the crude from Russia can provide some of that, so that's why within the OPEC Plus, there is more than just cooperation on the supply side. There is cooperation on every facet of the business, and this is actually part of it. So yes, the refineries in the Middle East will help stabilize again the products market, because it's not only production, it's what you sell into the market. And a lot of that is going actually to Europe now because of the need in Europe. And I think it will continue for now that they know how to stabilize and how to benefit from the situation. It will continue for a while. There is no reason for them to stop. They found a fine solution for all.
Yeah, and I suppose everybody's happy with that, including those who are implementing sanctions, possibly. Mark, just to talk about Europe a bit, we've mentioned a bit the US Fed and what it's going to do next. I mean, again, so much sort of instability on the financial side of things. 150 basis point swings in 2-year Treasury bills, which should be the most stable thing, right? So that just shows you how uncertain things are. But let's assume that and we've got the inflation report coming out today. Fed expected to probably keep going up with rates. What about Europe and the ECB? We saw some news, I think, coming out of the IMF yesterday about the UK beginning to slow that hawkishness down for obvious reasons. Do you think the ECB and Fed will start to diverge more now going forward? How different is the economic outlook for those two?
Well, I don't think the economic outlook is that different, but the ECB was always behind the Fed. So to a certain extent, it's still got a little more room to catch up. But I still don't think that we're going to get much more. I think between 50 and 75 basis points, but it will really be dependent on what happens with, above all, with the growth outlook. I think, in both in the Fed's case and in the ECB's case, the Fed's got CPI data today. The headline comes down very sharply, largely due to energy prices, both natural gas and gasoline. But the core goes up. That's what the forecast is, 5.6 from 5.5. It's not a level which the Fed's going to be comfortable with. It's not coming down fast enough. With the ECB, the problem is even more entrenched in terms of core CPI. They're not going to be happy with it, and I think they have to at least go twice more at a slower pace, 25 basis points each time. There probably may be a case for 75. With oil prices stabilizing where they are, this is really where the problem lies, that you're not going to get quite the sort of base effects that many were hoping for when we were down at 70. And I think that there's a sort of an important point here, was we're focusing obviously on oil at the moment, but if you look actually across the whole of the commodity space, particularly metals, if you look at gas, even in the agricultural sector, what you'll see is, yes, we've brought prices down from where they were after the Russian invasion from Q2 last year. But in all cases, we've run inventories down into the ground. One shock and everything probably just spikes again. And that's where the real great vulnerability is. Now, that shock could be better growth than people are expecting. It could be another supply disruption, but that's where the vulnerabilities lie, and that's where the vulnerabilities lie on inflation, and that's the headache for central banks.
I mean, Kieran, surely that shock is going to happen in the second half of the year, one way or another. We're either going to see China demand surprising us for a month or two, Russian supply again, being impacted perhaps more than it has been already. And give us your take on that, and how, if you think that OPEC can bring the supply back that's needed, and what about US production? Where's the market at in terms of thinking that can come partially to the rescue if required?
I think there's a realism and an expectation that as Sarah alluded to, that the investment hasn't gone into the US and the shale side of things at all. So, with regards to your expectation of some sort of shock, to a degree, you could say it's priced into the market. Everything's still in backwardation. There is, we are at relatively healthy flat price levels, considering we've gone through, we're into the fourth month of the year, and we've largely seen a stable oil environment, and perhaps maybe a letdown in demand brought on by the economy. So I'm not sure, as Mark and yourself pointed out, there are a number of areas where we could see a shock, but I would say it's priced in to some extent.
And what about, Sarah alluded to the Russian oil flows. Of course, we know continuing, a lot more of that coming into the Middle East gradually. Do you see that again, continuing as these sort of new oil trade flow shifts, and how again the shipping market is that adjusting accordingly, and is that going to be able to support as well?
Yeah, I think the shipping market has really adjusted. The tanker rates are extremely high. Demurrage rates are huge at the moment, and probably will remain so, to be honest. So I think seeing these reverse flows that have been widely talked about from west to east in some product grades. In terms of crude, it's been in the headlines this week. The Indian refiners buying record amounts of Russian crude. With regards to flows to the Middle East, it's obviously a lot more product based on fuel, naphtha, and diesel. Will that continue? I should think so. Obviously, price cap could come under review again and make things more difficult in that regard. But at current levels and where we've seen prices in the last couple of months, those products have flowed a little bit more easily. That crude has flowed to India and China fairly easily under price cap regulation. So I think we continue to see that persist over the next certainly few months.
Certainly into India, which again, as an economy, is the one that's really going to be holding things together, it seems, this year. We've got our survey question up there. Can Brent crude oil remain in the 80s, even with slower global growth and possible recession in the US and EU? So we've been kind of talking around those points. We're now stable back into the 80s. And can we stay there even if those recessionary fears become more real? Yes or no? And it's, of course, China's the big question mark. Sarah, we haven't had you on the podcast since we had Iran and Saudi making nice a couple of weeks ago. Give us your belief in whether that rapprochement is going to last beyond the handshake that we saw. We had someone on the program yesterday from Bahrain saying that, it's a nice temporary gesture, but there's just so many other problems in the region that this really isn't enough. Where do you think that's going? And why now? Why did we have the handshake 2 weeks ago and not, obviously assuming that we know that there's talks always behind the scenes, but what's the significance of making that statement today? You're on mute again. Sorry, Sarah.
So that is truly a very significant move because, we are seeing the first fruits of that in Yemen. Now there is teams in Yemen trying to bring Yemen to stability and to, sort out the issue of Yemen. So this is one of the first fruits of this cooperation between Iran and between Saudi. So if you go back in time, there was a period when King Abdullah and he was the king in Saudi, and they had a good relation. I mean, it was not excellent, but they had good relationship, and that actually created some kind of stability in the region. Now we are back into, I think, a better kind of relationship because it builds on trying to sort out. Sorry for this.
That's okay.
Yeah. So the issue here is that this stability will sort out many issues that we have. We started with Yemen, and I believe we can move into Lebanon. Definitely there is an angle to try to stabilize. As you see, the situation in Lebanon is horrible, and it needs some kind of interference in order to sort out the issue there. So this cooperation will bring a lot of value to this part of the world. And I mean, everyone came to the realization this tension and this animosity will not get us anywhere. And let's try something that actually will bring value. So I don't think it's temporary, because it is, who was the starter of this whole move was China. So China has some kind of big influence in trying to keep this moving. And I don't think it's temporary at all. I think it's for the longer term, and it's something that will benefit the region tremendously. So
well, hopefully that's the case. Obviously, it's a good starting point, but there are so many issues. Look at what's happening in Israel today, both domestically within itself and also with the continuing conflict with the Palestinians. There are a lot of hot flashpoints in the region. Yemen is being resolved, but we've got other things making up for that. Mark, back to you. Let's talk a bit about, again, back to finance and debt. You said earlier, I think, as we opened, the banking sector now is being more realistic about the problems within it. We've known what its issues are for years, and we're not really seeing measures being taken to correct that. Let's talk a bit about debt and debt markets, emerging markets, obviously being hit more and more every day by these higher rates, dollar-denominated debt, etc. What's the concern there? Probably at the IMF World Bank meetings as well, in terms of, will that hold back any policies that are trying to manage this whole mess? The worry about emerging markets.
Well, the worry about emerging markets primarily is obviously so many of those countries which have problems, particularly in Africa, have a lot of the debt is basically Chinese debt, i.e. they owe China money. And that's why China is such an important part. And thus far, it's been dragging its heels to a large extent in terms of finding some sort of way for debt resolution with a lot of these countries. And, we've got so many countries with the high inflation, with the high interest rates, with the vulnerabilities in both food and energy security terms. They've got a lot of problems and they need a lot of help. Meanwhile, we've got our own debt problems in the developed world. It's not like developed world debt hasn't been skyrocketing, particularly during COVID. And at some stage, there needs to be some sort of mechanism probably to work through. And my primary concern during the rest of this year is how much we're going to see in the way of rising corporate defaults, which would create an even bigger concern. To a certain extent, yes, it would check central banks because that's another issue which they would be worried about. But it is an ongoing problem and one which we keep on wanting to sweep under the carpet because, well, in truth, with global debt to GDP, I think in somewhere in 270%, 265% area, we know we're not going to pay it off. We just need to refinance it. And with higher interest rates come higher debt servicing costs. And that's the big vulnerability for all the emerging markets. And it does need to be resolved and resolved pretty quickly, actually, because otherwise we could face a situation where a number of countries start to default. And that's not a situation which is going to be great, particularly when we do need so much investment. We've been talking about the whole way through, oil sector investment is deficient. It's above all deficient in the US and in Europe. You can blame all sorts of things for it: higher interest rates, ESG, general, our ROI prospects, given the uncertainty. So the debt problem isn't going to go away. And I think it's going to be one which becomes more and more of an issue as we go through this year.
Yeah, and certainly attracting a lot more attention. Kieran, we'll go to you for the last word. We've got the survey result there, which is 50-50. I always suspect 50-50 results. But, again, it reflects the uncertainty of everything that, in the market. People are hedging their bets, I guess, either way on everything. But, your opinion on that. We've had some banks that are still saying that, we will see $100 oil this year. That it's coming. Others are saying, well, no, OPEC won't let it get there, even if if we're going in that direction. So give us, as a trading outfit, do you see less volatility going forward this year in prices, and B, do you think we could hit 100 if if we do see that China demand come back, if you like, and no recession?
Yeah, I don't think OPEC will stand in the way of getting to $100 oil. I think the majority of countries that are in the group wouldn't mind seeing it back at $100 oil, given their capital spending requirements at the moment, and that nervousness around the global economy that still exists. And so, yeah, I think that there's a degree of optimism in the market. It's just tempered by the economic headwinds right now. And yes, to reiterate my earlier point, there's a lot of focus on China, a lot of focus on the Far East markets, and they effectively have to lead us out of this price range if we are going to get back to that sort of $100 marker.
Yeah, and of course in China, it's all to do with their domestic policy. Of course, is beginning to turn around, but now they're coming down hard on finance, the financial sector. They've stepped off the gas with the tech sector, trying to let that get the economy going again. And we're seeing still some restrictions there. So again, and a lot of doubt in China as to how fast consumers will come back to be active. It's not the same as in the US or Europe. But thank you so much. We've run out of time. Thank you to Mark Ostwald, Sarah Akbar, and Kieran Gallagher for joining us today. We have the halftime talk feature interview coming up in an hour here in Dubai with Rory Johnston, which addresses a number of points on all the dynamics at the moment, one of which is that he was felt quite strongly that yes, the US is no longer a worry for OPEC in terms of competition of supply, but its production has not peaked at the 13 million originally, and it would be going up perhaps by 500,000 barrels a year going forward in terms of capacity. And there's some other headlines there and thoughts on OPEC plus and demand. So well worth a watch. Thank you so much, everyone, for joining us, and have a great day.
Thank you.
Bye-bye.